indicator analysis. So here we're going to be talking about how you can actually use your indicator, the common indicators around that you can use in order to make profit in the market and how they are being used. If you want to actually impute indicators in your MetaTrader 4 or your MetaTrader 5, all you need to do is to go to the F icon at the top of your charts. Then it's going to bring out a particular page. So there you're going to be seeing indicators right there, so you can impute the indicators. So indicators are essential tools in the Forex analysis, helping traders to understand market trend, identifying potential trading opportunities, and making informed decision. Indicators are just additional stuff on your chart that helps you to actually take a particular trade. Some use it as confirmation and some use it basically alone. So let us move on. We have the moving average. The moving average smooth out price data to create a single flowing line that makes it easier to identify the direction of the trend. And then we have 4 types of moving average. Like the moving average can actually be split into 4. We have the simple moving average, we have the exponential moving average, we have the smoothed moving average, and then we have the linear weighted moving average. The simple moving average can also be called the SMA, and then the exponential moving average can also be called the EMA. It is used to identify trend and also used for support and resistance level. If you've not talked about support and resistance, we're still going to talk about support and resistance in subsequent video. So like I said the other time, the moving average is usually used in order to identify trend. So right here, as you can see, this line is the moving average. Whatever moving average it might be, any period. So right here now, when the market actually cross the moving average down to this particular part right here, so most people believe that once it crosses a particular moving average, probably the 50 EMA or the 50 SMA, the trend of that particular market has changed. And sometimes people use this 100 period moving average and some 200 period moving average. The 200 period moving average are used to represent long-term trend, and the 100 moving average is used to identify the medium-term trend, while the 50 moving average is used to identify the short-term trend. So as you can see right here, when the market crosses, there was a movement to the downside. Like this, the market kept on coming down, and on the long run it went up again for a short while, and then when it crossed back here to the downside, it started coming down. So here, moving average can also be used to identify your trend. So moving on, here the moving average is used to identify the support. As you can see, when the price actually touched the moving average around this region, as you can see, the market pushed down. When it came, it pushed down. So later it went up, it touched the moving average again around this region, it came down, and then on the long run it broke it to the upside, and then it came down. Here it has changed trend. Some people believe that it has changed trend, and then right here it has also changed trend again. Later on it came up, it retested the moving average right here, and then it pushed to the downside again. It retested the moving average, and then it came down, and here it formed a consolidation around the moving average. So whenever there is a price movement in between the moving average, it is usually considered as a consolidating market. The RSI, or the relative strength index. RSI is an oscillator that measures the speed and change of price movements ranging from 0 to 100, and the key levels are the 70 level and the 30 level. The 70 level is stated to be the overbought level, while the 30 level is identified as the oversold level. It is used to identify the overbought and oversold condition, signaling a reversal. What do I mean by this? So people actually think or actually says that whenever the market or the price of the RSI actually reaches the 70 level, it is stating that the market is about to reverse to the downside, while whenever it reaches the 30 level, it is about to change to the upside. So let us identify them on the chart. So as you can see now, this is the RSI right here. This is the RSI right here. This box right here is the RSI, starting from this line to this line. If you can see it very well, this is the 70 level. This is the 70 level right here, and this is the 30 level. As you can see, when the market actually came down right here, it came down and then it touched the 30 level, which is the oversold. The market reversed from that point, and when it actually got later on, if you can actually take the trade a little bit from here to this place, you are in good profit. So when the market came down here again to this region, on the RSI too, the market was actually on the oversold region, and then it made the market go to the upside, as you can see. Also, when the market got to this particular overbought region right here, this is the point right here, the market also came down. If you don't actually understand, you can just go again, or you should plot it on your chart and then see how it actually looks like. And also, whenever it touches all this line, doesn't mean it's going to reverse immediately. Just for an example, when the market actually touched the overbought region here, as you can see, this is the region around this place, the market kept on going up before it later retraced a bit before going to the upside again. So if you are going to be taking your trade on oversold and overbought region, you need to be very, very careful and know what the market is actually telling you. So also, the RSI can also be used to identify the uptrend and the downtrend. For example, if you plot the RSI, you can also add another level, which is the 50 level. So whenever the RSI crosses the 50 level right here, this was the particular point the market actually crossed the 50 level. As you can see, the market went to the upside, and again when it crossed the 50 level to the downside here, as you can see, the market came down immediately, as you can see, like that. So the RSI can also be used to identify the trend of the market. So now the MACD is also called the moving average convergence divergence. It is a combination of moving average to show the relationship between two moving average of a security price. So in the MACD, we have the MACD line. This is the difference between the 12 moving average and the 26 moving average, and then we also have the signal line, which is the 9 EMA. So let us just go to the chart. Okay, it is used to identify change in the strength, direction, and the momentum and duration of the trend. So this is how the MACD actually looks like here. As you can see, this particular chart right here. So this one right here is a MACD. As you can see, it has a kind of oscillator right here. They call this line oscillator, and then that is the relationship between the that is the one they call the relationship between the 12-day and the 26-day moving average, while the red dotted one right here is the signal line. So how do you use the MACD? So the MACD is also used to identify the overbought and the oversold region. As you can see, when the oscillator got to this particular region right here, which was the peak, the market came down from that region, and when it actually go to this trough right here, the bottom, so the market changed to the upside a little bit before it came down. So MACD can also be used to identify trend. So whenever the signal line or the oscillator, depending on you can use the oscillator, you can use the signal line. So whenever the signal line or the MACD oscillator crosses the center line, it is stated to be a change of trend to the upside. So as you can see right here, when the oscillator actually started printing to the upside around this region, around that region right there. As you can see, the market has started going up from that particular region too. From that particular region too, the market has started going to the upside around that region, and then the market went to the upside immediately. So that is how it is. And if it actually crossed it to the downside, as you can see it right here, when it crossed to the downside around this region right here, the market was already coming down, so which state that the trend is about to come down again. So let's continue. MACD can also be used to identify the divergence and convergence. So right here, this is a divergence right here. When the MACD is actually creating the lower highs, but the chart is actually creating higher highs, it shows that there is a divergence in the market. What do I mean by this? So here, the chart is actually moving up, but the MACD is actually coming down. So it is actually signifying that the market is about to reverse to the downside. So that is how convergence and divergence actually look like. And so let us move on. We also have the stochastic oscillator. Just like the RSI, the stochastic also have two lines that are being used to identify the overbought and the oversold. The 80 is the overbought and the 20 is the oversold. It is just the same explanation that whenever the RSI reaches the 20 level, it is measured as the oversold, so the market is about to reverse. That is how the stochastic too also look like. But the difference between RSI and stochastic is that stochastic has two lines. So right here, as you can see, when the market actually go to this particular 80 level, the market change the trend, and when it go to this 20 level, change the trend to the upside. As you can see, it also has its own downside. As you can see right here, the market actually go to the oversold region right here, but then it never reversed from this point. Here too, it go to the oversold, but it never reversed to the downside. So you need to be very, very careful whenever you're using any kind of indicators. Indicators do lag. It's never prints first. Price prints before the indicator actually reacts to the price. So the price is what the indicator follows. So there is no indicator that is going to forecast the future for you. It is only going to be printing according to what the market is actually doing. So moving on, we have the parabolic SAR. This provides potential entry and exit point by generating signals when the direction of a price is changing. So for example, now this is how the parabolic SAR actually looks like. When this dotted line, this arrow is not actually there, it's just to identify that that is where you can actually take trade. So for example, when this up dotted line actually change to down, it shows that the market is about to go up. As you can see, the market started going up, and whenever this dot stop printing down and then it started printing up, it shows that the market is about to come down. So as you can see, it came down a little bit, and when it stopped printing up again, it's printed down. It shows that the market is about to go up. So right here, whenever the parabolic SAR actually prints, for example, let us use this point. Whenever it prints right here, you know, if you take your trade around this region right here, you can put your stop loss around this region, and then you can look for another way to put your take profit, or you take profit immediately you see this dotted line here, this dot right here. You're going to just take profit, and then you probably enter your buy trade. As you can see, you're going to see a whole lot of false signals. That is why I said you should be very, very careful whenever you're using indicators. So there are so many indicators right there that you can actually use, but these are those the common ones that people actually talk about. That is why I am explaining it, for you to be able to know how it is in case you are a complete beginner. So that is why I'm actually putting this out there, so that you can actually understand how they work. To me, I will advise you, whenever you want to start trading, focus on the technical part, which is the price action, and other strategies like the SMC, the support and resistance, the trend lines. So you can now use the indicator kind of strategy to do a kind of confirmation. You should be using it to confirm your particular trade. So that will be all about this video. If you are yet to subscribe, please try as much as possible to smash the subscribe button and give this video a thumbs up. It will help the channel a lot. Thank you very much. See you in the next video.